Alright, so in the last session we talked about the first of the setups that we use, which was the contextual alignment setup. Now, I hope you've realized by now that, pretty much any trade that you're going to take should have some sort of alignment with the overall context. Okay? So, we noted and we specifically mentioned it in the key takeaways of that session that the only reason that was being made a setup in and of itself was because when we had strong contextual alignment with a strong support or resistance zone, we don't need anything else to enter a trade. So in effect, it becomes its own setup, right? The trade idea that you form based on the context and the specific zone becomes its own setup, and you can just take the trade right at that zone without waiting for anything else to happen. Okay? Whether it be any indicator or price, you can just take it at that zone. And that's why we separated it into its own setup. In reality though, you're always analyzing context, and you're always looking for the context to align with whatever you trade you're going to put on. But like we mentioned in the 9 principles of tactics in our last section, there are some zones that are virtually going to be automatic fades. Okay? Some others, like we discussed in the last session, pretty much become an automatic fade intraday based on the context, right? So you just know based on what's happening intraday on the bigger picture, you just see that a trade at that zone would make a lot of sense. So in a sense, you can just enter there too. They become an automatic zone even if they weren't, seen ahead days before. But then there are going to be instances, which we talked about in principle number 2 of the tactics, which is you're going to have some scenarios where you do have a zone. It's not a very important zone that's just like crying out for you to put a long or a short trade there, but it's a good zone. There's support or resistance there, and the context is not outright against it, right? But you want to see something else there to warrant a trade, okay? I.e., the contextual alignment is not so obvious to just warrant a trade right there. But if you were to see something else that gave you good odds, then you could take a trade at that zone. All right. And that's what the next 2 setups are all about. And so, what are those other 2 basic setups? Well, one of them is the exhaustion setup, and the other is the divergence setup. So you see, our setups aren't specific little setups that some other trading educators might teach. Aren't, well, you wait for this to get to this exact level, and then for this bar to close here, and then for this indicator to line up. We don't look at setups in that way. We look at trade ideas based on context, right? And what often helps a trade idea form, if it's not outright obvious in and of itself based on the context, is that either you have an exhaustion that seems to be happening at a zone or a divergence. And in that case, that gives you the good potential for a good trade. Now, the interesting thing here is that we've already done a lot of talking about this, and you should remember from the first section, the market framework section, when we talked about market internals, we went deep into these. We even had many drills that taught you how to look at these, what to look for, and everything. So in essence, if you've done that section, if you've studied those videos, done the drills, you've already done all the work that is required for you to be able to spot these setups and now to trade them. All right. Now, if you don't trade the S&P or, the other equity indices, then you're not going to be using market internals, right? But here's what I'm going to tell you. Those sessions are actually quite important because the principles we use when we're looking at market internals, right, we can use with anything else. So if in your trading you happen to use standard technical indicators, like stochastics or MACD or RSI or any of the other stuff that a lot of traders use. Now, we don't personally use those because we don't see a need for them, especially since, we're mostly S&P traders and the S&P has its internals, so those are more than good enough to give you a great other type of view of the market other than price itself. But, even if you use indicators, you can use these concepts and these types of setups with those instead of with market internals. All right. And so I would say go ahead and study that section and think in terms of principles. If you're looking at a market internal divergence or an exhaustion, instead of looking at the market internal, replace your specific indicator and just use the principles as discussed. All right. Now, we're going to get into the charts right now and show a couple examples of this. There's definitely no need to go deep into it again because, again, we went into it very extensively and we had several drills all about this stuff in the previous sections. So definitely review those. But now I just want to show you how you would actually execute using these things, right? Like, how would you actually enter, when, where would you put your stop, that kind of thing. So let's get into the chart and take a look at these two different types of setups. And let's start with setup number 2, which is exhaustion. Alright, so here we are on the charts to show an example of an exhaustion setup. Now, on this particular day, which we had seen in the past, we had gap down really big. Okay, we looked like we could be potentially about to trend down, but we had hit some major support area here from a larger context, and we reversed basically, and we're trending back up near the high of the day. Now, we've talked a lot about pre-market prep and always having the zones and the levels in before the market starts and then using tactics as the market opens. But of course, it should go without saying that as the day is trading, new zones can be built intraday. For instance, what's a good resistance zone that was built in this particular day itself? Well, it's not really hard to see that, this particular zone right here, where we had open, shot down, tried to retest it, couldn't, and then broke down all the way for this big leg. On an intraday basis, this could act as resistance if we come back to test it. Alright, so let's draw in this resistance zone. Okay, so here it is now drawn in. Now, how significant is this zone in and of itself? Well, it's by no means an automatic sell zone, right? It was built intraday. It was two previous highs from the intraday level, and the move that started was an intraday move. So, it's important to look at, but it's not definitely by no means an automatic sell. Now, when we look at the context, we see, this is definitely bearish overall movement. We had gap down huge and all that. But then we have met major support down here, and now we're reversing. So things seem somewhat balanced with a slightly more negative bias to it. So it would make sense to look for a potential sell here as we come to test this area, just because of the whole negative bias of the day in general. But again, it wouldn't be automatic. Like, we wouldn't just be placing an order just to sell right there. We would have to see something. So let's take a look at this. What do we see here? Well, we see that we had already been moving higher and higher and higher with very little rotation down. And then at the end of this came a major volume thrust. All right. And if you look down here also, there was a corresponding extreme in the NYSE tick, which was in line with the highest extreme that it had seen for the rest of the day. But this was also coming with the volume. Well, volume is actually a good thing if you're breaking out of a certain area. You want to see, big volume if you're breaking out of balance or anything like that. That's a good thing at the beginning of a move. But now this was coming after we had already moved nearly 10 points higher with very little pullbacks. All right? And it was coming as it was slamming into this previous resistance zone of the day. So this is an example of a setup like this, the exhaustion setup, right? The zone in and of itself is nothing too major. The overall context or bias is definitely not against a short trade. It's probably more for one than anything, even though we're moving up, but bigger picture, this was pretty bearish. So, it could warrant a short, but not just by itself. But now when you add the exhaustion to it, well, now it's telling us, hey, not only is the bias not really against it, it's actually a bit more for it. And not only is this a decent zone that had caused a pretty good sized move from the morning, and is the current high of day, but we're also hitting it with some exhaustion volume after already moving up, close to 10 points. So what does that tell you? Well, now this becomes a good setup, right? And this becomes the exhaustion setup. Everything is not perfectly aligned, but we're seeing exhaustion, right? We're seeing short-term buying pressure. Now, for all intents and purposes, most traders would look at this and this would seem scary. Like, why the hell would you be selling here if it looks so great? We got a nice up candle, it's closing at its highs, we got very good volume. Well, that's what exhaustion is. By default, it has to look good at the point of exhaustion. And that's where the retail crowd's coming in, and that's where the amateur traders are coming in to buy at this point because things have been going up for a while, and now in their mind it's confirmed, right? So they think this is a good buy. But more than likely, this is probably the end of this move on a temporary basis, and you're going to get some sort of reaction the other way. Now, this does not mean that this is the end of the whole move and we're going to be going down all the way, right? It just means that you're very likely to get some sort of reaction down that's bigger than the 2 point reactions down. All right, and that could be a decent high odds trade at this moment. So, if the big volume bar, right, came right here, and so the high of the bar is currently at 12.5, it's closing at 12.25. Let's assume, you're getting short right there, right when you see this, right? Now, realize that right when you see it, it's seeming scary, but you can't sit there and wait for a down move to confirm it. You gotta take it when it looks scary, as long as it's in a zone. Don't just start taking these arbitrarily whenever you see high volume. And make sure also, I have to note, give you caution here, make sure you're not fading an outright trend, because that'll just keep going and going. But here the contest, of course, is not a trend day. It's just coming back to test the previous high of the day. And this big volume is not coming out of a breakout out of a balance, but coming after a pretty sizable move up. So all those put together, you're sitting here, you're trading, bam, you see this take up and you see the volume, take the trade, take the short right there. It's hard, but that's what you have to condition your mind to do if you want to take these kind of trades. Now, of course, you can just not trade this setup. This doesn't mean that you have to trade it. You might want to stick to the contextual alignment setups, because those are more high odds, but these will generally work quite well too, setups like these. And so let's see what happened here. All right, as you see, if you had waited, look at that instant drop. So you got to take it right there when you see the volume is hit high, when it looks all bullish, when it looks scary, it's right in the zone, that's when you take it. Again, assuming context is not against it, in which case you don't even want to be fading it. And so there you go. It dropped from 12.5, and by the time we were here, it already reached 8.5. That's 4 points. If your stop was a 2-point stop, that's already 2-1. And when the odds of this reacting down are more than 50-50, which in this case, they likely were because of the exhaustion, then that's pretty good to have a 2-1 reward to risk with maybe a 60 or 70% chance of this thing coming down. So those are the kind of trades you want to take. Now, of course, this does not look like a big reaction, and you don't need it to be. Sometimes you can get those nice, 1.5, 2.5 to 1 reward to risk, especially since here you can use a tight stop since your stop would just be right beyond this zone. Okay? So this is a typical example of an exhaustion setup. All right? Now what about a divergence setup? Well, let's take a look at that too. All right, so now we've moved to a different part of the chart to talk about the divergence setup. Again, this was covered extensively in the market framework section under the internals. There were drills. Go back to those, study them. All the information you need to trade this is there. Now I'm just showing you how to actually apply it to a specific trade. All right. So in this context, we're looking at the market after it had had that major breakdown and had that failed upside breakout of the balance area, then tanked down for several days in a row, had major moves down. This particular day retraced some of that and just ended up bouncing in the afternoon, and now we're starting a new day right here. All right, so let's zoom in closer to that and see how this divergence setup worked. Okay, here we are. And so we're trading this day that had just opened and started up. Now, in terms of immediate zones, well, we have a small resistance zone right here, which was basically the last swing high, right, before the close. It was the last tail. The market had tried one final time to go up, was rejected, had this mini tail, and it ended up being this last swing high before the close of the previous day. So that'll often be, a support or resistance zone. It's more important if the last day was a trend day. If this particular day had been a trend day, the last swing high would have been very important. In this case, it's just something to note. It's there, right? We look at it and we realize that it could provide resistance on a test up, but it's by no means an automatic zone. We have to watch it. So let's draw it in for a sec. Okay, so there's the zone. And here's what's happening in the morning. We open up, we go close to the zone, right? And then we shoot into it. Now, we don't have an order in there. We don't have anything because this is definitely not an automatic fade. But as we shoot into it, it comes down a bit and then we shoot right back into it and we kind of try to move higher inside the zone. Look at what's happening to the advanced decline line of the NYSE. This thing, the S&P, is moving higher, makes new highs here, and then makes more new highs here. But look at this. It's just tanking straight down. All right? This is a divergence. It's showing us that despite the S&P moving up, the majority of stocks are actually going down in these moments, and this short-term strength that we're seeing is not being supported by the majority of stocks. Okay. Not only that, it's also not being supported by the NYSE tick. Let's look at that for a sec. Right, so now I've zoomed in on the NYSE tick, and as we see, even though it's technically neutral in and of itself, it's just a very small readings, it's also diverging as we move higher. It's not even being able to take out the previous high. There's just no real strength behind this push in terms of the underlying stocks as a whole. So we're seeing divergences from both these internals, and quite frankly, you might get in trouble if you try to look at tick divergences. So I would recommend just sticking to the advanced decline line ones, all right? Unless there's just some major tick divergence. The advanced decline line ones are definitely better and they give you better odds. These will happen so often that you're going to overread them and think you always have divergences. So fine, you can use them to help you confirm the advanced decline line ones even more, but I wouldn't recommend using them on their own. All right, the tick again is useful for just seeing the general character of the day, not so much for the divergences. It's also useful for having good entry points at extremes, and we'll see that specifically when we look at how we trade trend days and the setups we use there. Okay, but for now, let's bring back the advanced decline line into view. All right, here we are. And so what would you be doing here? Well, here's the thing. Right when you saw this initial one, this thing popped up in here into this resistance zone, but the advanced decline line was nowhere near. that could be a trade right there. It was nowhere near its high while this one was at a new high. Now, if you want to be a bit more conservative, since this isn't such a major zone, you might have been wanting to wait and see if we try to push up even more, what happens. And when we got this second push up, we saw not only did it not make new highs on the day like this was doing, but it didn't even take out this previous high. So now we have what's called a double divergence, and now your odds are quite a bit higher, right? So these will prove to be good ones when you see these kind of double divergences. So at this point, you do not wait to see a down move to get in. Again, we never wait for that kind of confirmation. You see this, it pops up, and this is still right here. As we're hitting up here, just take the trade. Take the short right there. You know, that would have been what, an 80.5 short, 1380.5, and your stop could have been right around here, a couple points higher, just above this zone. You know, in this case, 2-point stop, or even maybe 1.75 point stop, somewhere around here above 82. And that's it. Okay? Now, yes, there's a risk that this thing pops up while this is a divergence, but then it just keeps going up, and then the advanced decline catches up and there's no longer a divergence. Okay? That can happen. But like I've tried to drill into your mind over and over, you can't think, what if this happens? You got to think long-term probabilities. And long-term probabilities show you're at a resistance zone, you're seeing a double divergence. Yes, once in a while this thing will keep going and it'll erase it, but what about all the times that it works? Don't think about trying to avoid the loss when it doesn't work. Just take it and bet on the long-term probabilities giving you profits over time. Alright, that's what you got to do. So let's see what ended up happening here. Okay, the next bar pops up yet again. Now you should already be short here if you were taking this trade. But you see this bar popping up yet again, but yet again, another divergence. Yes, this thing popped up, but it's still even lower than this one, even though this one's higher than here. See? So as scary as this would look, you would stay in the trade, right? And now let's see what happens. You see this? You instantly got the down move, and then all of a sudden, we're 5 points off the high. And if you had gotten in at 80.5 with about a 2-point stop, you've had 4.5 points of down movement. That's already over 2 to 1. You've filled this gap. This is the gap close right here. A decently logical profit target would have been for this gap fill. And you got a 2 to 1 reward to risk trade right there. This doesn't seem like a lot of movement, but sometimes that's all you need to have some good trades. And this was pretty high odds. Despite the zone not being a major zone, the contest wasn't necessarily against it, but then when you saw all this, take the trade, right? And that's a typical example of a divergence trade. Now, these type of exhaustion divergence trades, they happen quite a bit, but not from the sense that they're good enough to take a trade. You want them to happen at a zone with the contest not against them. Don't now all of a sudden just be looking for divergences everywhere and exhaustions everywhere. They got to happen at a decently good zone, and the bigger context can't be outright against them. If that's the case, they're good. And they don't happen that often in those specific terms. So make sure you're being selective with these. But having said that, when they do happen, they're good. And you can make decent money with these kind of trades. And that's why they're a couple good setups. Now, as a final thing, the last thing I want to say about these, and the reason why, there's setups that we look at, is a lot of the time what will happen is that they will occur at the same time that you have setup number one, which is contextual alignment. So they'll happen at a time where you should already be taking the trade. And what end up happening is that they will just give you even more confidence in the trade. And they can give you even more confidence in terms of holding the trade longer in certain scenarios, right? Instead of being nervous, you get in the trade, but then it just stays there. It doesn't really move right away, and it kind of chops around there. Well, if you have the bigger context the bigger alignment setup, and one or two of these, the odds are quite high. So basically stick to it and see the move through and feel even more confident in entering. So sometimes they help in that. Let me give you an example of that. All right, here we are at a pretty good example. You should remember this particular day, we've discussed it several times now. This was the time we hit that automatic sell zone, all right, and we ended up having that big downtrend day. But we also remember that we ended up coming back and revisiting this area. Now, was there a trade when we revisited this area? Well, let's take a look at that. This had been the automatic sell zone, and we had the first test. So now we were getting the second test of this zone. We said the first test is always the more important. However, in this particular case, this test was also still important because the last time we tested it, we had an important down move off of it, pretty strong down move. So this was like the launching point of pretty strong directional conviction, and now we're hitting it. So on the one hand, it's a second test. On the other hand, the reason why I drew 3 lines is because it's kind of to show that there was another reason to have resistance here now. So, still a pretty important area. However, not an automatic sell anymore, just because we had tested it, come down, held here, and now coming back up, looking for all the world that things are going to head pretty much quite a bit higher, right? But what about on this specific day? Just because the bigger picture was saying that things are going to head higher does not mean that on this specific day there couldn't have been a good short here. So let's zoom in a little more on this day and see what was happening there. Okay, so here we are on this day. As we see, this day opened up and just balanced for the first over 2 hours. And then finally we got a breakout out of the balance. Now this is of course bullish, so you definitely don't want to stay in its way. And this huge volume is actually a good thing because it's happening on a breakout. All right. But then, after that, we kept going up. And now as we came up and we were hitting this resistance zone, right? What did we see? Well, we saw another volume spike. Pretty decent one too. Not as high as the first one, but it was 2 volume bars in a row that were pretty high. But what was the context of this? Well, now this volume spike was coming after we had already had, a 9-point straight, pretty much straight up move with no retracements. So in this context, it was coming in the form of a mini exhaustion. Now, given the fact that there's already an important resistance zone here, and it's not just any one, it's a pretty important one, and we're seeing exhaustion, now we think this could be a pretty good trade here. See, the cool thing about this is that, on the one hand, this is a pretty important resistance zone. On the other hand, it's not a pure automatic sell, right? But because we're approaching it in the manner we are, and because now we're seeing this potential mini exhaustion, it makes sense to take a short here. Because even though the bigger picture may be up and we're about to go higher, short term, it seems like we're not going to be able to break through because high volume is coming in and we're no longer in a breakout scenario. It's coming in after a good move, which probably usually means that a lot of the retail crowd and all that is now finally piling in. It's showing exhaustion. So again, you don't wait for this. You see this couple big bars and it's hitting it right as it's hitting the zone. You just take the short if you want to there. And the exhaustion helps you take a short here. Now in this case, you might not have been a bad thing to just take a short outright, but it was, a bit undecided. Once you see this other setup confirming it, then that gives you better odds and you would be more comfortable taking the short there. And so this is a concept that we talked about before, and it's called the concept of confluence, right? And it doesn't just work to give you better zones, it also works in the setups themselves. The more setups that align, the better the odds. So, we have setup number 1, which is contextual alignment of having an important zone and being stretched going into it. And then we have the actual exhaustion point potentially happening. So this would often be a good trade at a good short. And let's see what happened here. And by the way, let me just show you also the tick. We got an extreme that was close to the extreme we had seen at the breakout move, but this is again now happening after a lot of movement, so confirming the volume. On the advanced decline line, there was no divergence, so if there was, it would be even higher odds. Now let's see what ended up happening. So as we see, we hit it, and we definitely tanked down, and then even at the end of the day, we ended up going down even more. So from here to here is a 7-point move down. Now, you might not have sat around and stayed in the move all the way for 7 points. But again, if you had about a 2-point stop here, which based on this zone it would have allowed you to, then you easily got at least 2-to-1 reward to risk, which is also good. So that's how these things work. You can use them on their own in certain times, and you can use them as confluence and other times to give you more confidence in trades. Just like we said, you're going to have to get used to taking them when they seem the scariest. Other traders can't do that. If you learn how to do that, you'll have an edge. So, having said that, those are your 3 fade setups. We've now covered them, and you should have a good idea of what to look for.